Welcome back. This video is all about how you can actually use your field labor budget in the day-to-day management of operations in your business. As mentioned in the previous video, building your labor budget, nothing is more worthy of your management time and effort than investing in managing your labor. If you can't manage profitable, productive field labor, you're never going to be able to build a profitable business. So in this video, we're going to show you how you can manage your company better by actually using your labor budget. And we'll focus on a few key concepts. How you can set profitable productivity goals. That is, how much work do you need your staff to produce? We'll also look at how you can measure your actual results. How much work is your staff actually getting done, and are you on track to hit your goals? And we'll also look at how much your people, especially your key people, are really worth. And finally, we'll take a look at the big question. How do you get your staff thinking and acting like many owners in your business instead of just hourly employees? A lot of these answers are going to come back to one single, simple number. This number is your field labor ratio. You can see this number right here on your labor budget. It's the last bit of information in the top section. Calculating your field labor ratio is simple. You take your field labor payroll costs before burden, and you divide those costs by your total sales. This shows you exactly what percent of money coming into your company gets spent on labor costs to get the work done. In other words, this is a great measure of your productivity. The higher the ratio, the more of your sales you're spending on field labor wages, and consequently, the worse your productivity is. The lower the ratio, the less of your sales you're spending on field labor, and obviously, the better your productivity is. Of course, if you go too low, your staff is going to realize they're underpaid and they'll leave you, so there's a fine balance to be made here. There is no perfectly normal ratio for the landscape industry, but there are some general benchmarks. First of all, you have to recognize that a normal ratio for one type of work is not normal for another. In maintenance, lawn care and grounds maintenance, for example, there are very little materials installed. Labor ratios are much higher for companies who do maintenance work when compared to their peers in landscape construction. Material costs on construction projects drive up the price of the project and reduce the cost of labor as a percentage of the whole job. Although there's no perfect number for any company, you can compare your company's results against some industry standard benchmarks. To do this, just click the Review button on your budget screen beside your field labor ratio result. Next, you'll have to enter the percentage of revenue that your company brings in from each division listed on the screen. For instance, if you did 50% of your sales from construction, 25% from maintenance, and 25% from snow and ice control, you'd enter your percentages like so. Make sure your percentages add up to 100%. When you're finished, click the Submit button. The screen will show you what's normal, low normal, and high normal based on industry statistics for your mix of work. Another good way to analyze your numbers is to go back to your previous profit and loss statements for your company. Find out what your field labor ratio was last year and the year before. Remember, not all payroll costs get included in this number, just the costs of your field staff. If you're using historical numbers for your company, make sure you're not including overhead wages in your numbers before you attempt this calculation. Once you've completed your budget, you've got a profit that you're satisfied with, your labor ratio will tell you the productivity you need to get from your people. For instance, let's imagine Dan is running a design build company. He finishes his budget, which is earning 10% net profit, then he reviews his labor ratio. It shows him 22%. From here, Dan has a crystal clear goal for his company. His field labor wages need to be 22% of his total sales. Each crew should be able to hit that ratio. Dan can now set clear production goals for each one of his crews. Let's look at that. Dan's got a crew with 3 staff in it: a foreman, a lead hand, and a laborer. Dan then forecasts their annual wages. The foreman's likely going to work 1,800 hours this year, and he makes a wage of $20 an hour. Lead hand usually works 1,600 hours. His wage is $16 an hour. And there's a laborer in this crew who works about 1,300 hours a year, and he makes $14 an hour. To keep this example simple, we're not going to factor overtime wages. But if you were really calculating this ratio for your company and you pay overtime, you'd have to make sure the cost of overtime pay was included as well. So multiplying these crews' hours by their wages and adding it all together, Dan can calculate this crew's forecast annual wage total at $80,000. With his field labor ratio, now he can set a production goal for the crew. Since his field labor ratio is 22%, all you need to do is divide the total wages, which is $80,000, by 0.22, which is 22%, to come up with their production goal. The answer is $363,636. And we'll just round that up to $365,000 to keep the numbers nice and simple. To achieve Dan's plan for profit, he needs this crew to be able to produce or get through at least $365,000 worth of work this year. Dan, of course, needs to make sure that he sells enough work, but it's the crew and primarily the foreman's responsibility to get through their jobs efficiently enough to make sure that they hit that number. You can assign crews to your invoices in your accounting. That way you can report revenue, invoice sales, by crew. Or you could create your own spreadsheet for tracking it if that's easier. It does take a little work, but if you're not keeping score, then who is? If you don't care enough to track it, there's a better than excellent chance that your crews aren't going to care enough to achieve it. So if you have a crew or foreman who produces more than their goal, that's even better. This is a crew and a foreman that we want to keep around. Crews that can beat their goals are worth a lot because they're making us a lot more money. So you want to be able to offer them higher wages and bonus incentives to reward their exceptional performance. This is because work beyond your sales goals is really profitable for your company. Chances are that you're probably not spending any more on overhead. You won't need to purchase any more equipment, and you shouldn't need any subcontractors to do the extra work. You're not going to need to buy an extra truck, and your rent costs certainly aren't going to increase if your crews squeeze in a few more jobs before the end of the year. This means on work over and above your sales goals, the percent of revenue that usually gets spent on overhead and equipment and subcontractors now becomes super net profit. To explain this better, we really need to understand how overhead recovery works, and that comes later in this workshop series. But if you are interested, there's a video in the download section that'll explain bonus systems that you can implement and how they work. But we recommend that you watch the overhead recovery and pricing system workshops first so that it's all going to make sense to you. Now, all too often in landscape companies, there's a few people who end up carrying the weight of the company while the rest of the company spends the profits of these superstars on their waste and their inefficiencies. In this all too typical situation, owners can't afford to pay the superstars what they're actually worth because the weak crews end up spending the profits of the good crews. Eventually, your superstars grow frustrated and they leave you for better opportunities. Now, your chance of finding another great foreman is probably somewhere in around 1 or 2 in 100. So you probably end up replacing your good foreman with weaker links. And now your whole company is struggling to break even. Crews that can't hit their goals not only are costing your company money, but they're driving out your superstars or they're bringing everyone else down to their level. Substandard crews have to be dealt with if you want to run a profitable business. If Dan's got the sales, but has 1 or 2 crews who aren't hitting their goals, Dan can tell exactly where Danscaping's problems are, and now we can deal with it. Foremen who aren't hitting their sales goals either need to be paid what they're worth, which is less than they're being paid now, or they should be given the opportunity to go and drag down someone else's profits, hopefully one of your competitors. Just remember that different divisions in your company will have different ratios. A company ratio might not work for all types of crews. For example, Dan's 22% goal might be perfectly acceptable for a foreman of Dan's construction crew, but it might be too much to expect from a maintenance crew. A maintenance crew doesn't install any materials, and their labor ratios are typically higher than a construction crew's. A budget for each division in your company is going to establish clear and accurate goals and labor ratios for each type of crew. In the download section of this video, you're also going to find a crew production goal calculator spreadsheet. You can use this quick spreadsheet to quickly calculate production goals for your own crews based on their wages and your company's labor ratios. Using this spreadsheet, you can also see how adjusting wages will affect sales or production goals. For example, $5,000 worth of raises for an entire crew might mean you need to demand $25,000 more production this year to be able to afford it. But communicating this kind of simple information helps us engage everyone in the company around a common goal. As we improve the company, we can all improve our standard of living. You can also calculate fair wages for your superstars, who do get their work done quickly and who manage more people and bigger crews. These foremen are worth more than your average foreman. How much more? Well, let their production and your company's labor ratio give you a pay for productivity system that works both for your employees and for your business. Dan used to have problems knowing whether he was doing well or not. He had a gut feeling for how things were going, both in good times and in bad, but never quite knew how good or how bad it was, until, of course, his accountant at the very end of the year handed him back a statement that told him. Using his field labor ratio, Dan now has a tool to see as the year goes on whether his company's on the right track. In just a few seconds, your accounting software can produce a report that'll show you exactly what you're spending on field wages, and if you divide those wages by your total sales to date, you've got a current field labor ratio. Now this number is of course going to be off at the beginning of the year when your work's just getting started, but by the halfway mark of the year, the ratio will give you a really good indication of whether you're on track or not to make your budget, which is your plan for profit, become a reality. And the great thing about a labor ratio is just that it's that, a ratio. You're not trying to manage your spending and labor in fixed dollar amounts. If your sales are going up or down from your budgeted forecast, then using a fixed dollar amount to evaluate your labor spending isn't going to work. Ratios move with sales. If sales are up or down, your ratio is going to tell you how your labor spending should be adjusting itself as well. This helps Dan manage the worst case scenario that so often hits contractors really hard when the economy goes dry. Sales dry up, but labor spending doesn't fall in the same proportion. And it doesn't take long to get into real financial trouble when you're in that situation. Dan can also use the labor budget to create incentive systems for his crews that really work for both of them. Let's take that crew that we already looked at earlier. At $80,000 in wage costs and a 22% labor ratio, we figured their production goal was around $365,000. But what if that foreman was able to produce more than $365,000? Would he or she be worth more? Sure they would. The business is making more profit without spending more on overhead. Customers are happier because their jobs are getting done quickly and efficiently. And that foreman is training the workers in his crew how to run an efficient job. You really need a system that tells you exactly what this foreman is worth, as well as how much you can afford to pay them. So what if this foreman got through $400,000 worth of work? Well, 22% of $400,000 is $88,000. This foreman's crew wage budget could jump from $80,000, and that was the total of their wages we calculated earlier, up to $88,000, which is an $8,000 improvement. Don't divide that money evenly among the crew, though. Your foreman is the linchpin that makes it all happen. Make sure that they receive the most of this wage increase. You might decide to add $5,000 to the foreman's annual wage and give raises to the crew that equal the remaining $3,000. Laborers are replaceable. Good foremen are really hard to come by. Dan's happy because he's making a lot more profit on sales over and above his goals, since he's not likely spending any more on overhead, equipment ownership, or subcontract costs to get this extra sales in. Now his foreman's happy because he's got a real, meaningful incentive to produce more, and so do his crew. It's going to put more money in their pockets. Now, without a system like this in place, what's your crew's incentive to improve their productivity when they're paid by the hour? Nothing. In fact, the faster they work, which is good for you and your customer, the less your crew might get paid. At least that's the way they're going to see it. Now, some of you might be asking yourselves, isn't this going to affect my quality? Aren't my crews going to rush through their jobs to get more sales in? And therefore, aren't my warranty costs going to go up? In our business, we saw our quality actually improve after implementing this system. For 3 years straight, we reduced our warranty spending on both labor and materials. But it came down to simple training. You need to explain this very simple concept to your foreman, and don't skip this step. If they have to go back to fix work, to take care of warranty issues, their labor costs are increasing, and their sales aren't moving. Warranty work is free work. Your sales aren't increasing. When labor costs are increasing and sales are staying the same, that's hurting your foreman's labor ratio, which means they're going to have a much harder time getting a raise. But warranty work is even worse. While your crew was back at a site for half a day to fix a problem, what should they have been doing instead? Working on billable work, of course. So now, not only are their labor costs rising, but they're losing precious time to hit and beat their sales goals, which is also costing them wage and bonus opportunity. An important piece of this system is to ensure that the foremen take care of their own warranty work. This may cause you some scheduling headaches, but in the long run, it's a far more effective system than frustrating other foremen who have to go back to clean up shoddy workmanship of foremen that came before them. When your foreman realize that a day lost in construction work can easily cost $2,500 to $3,000 in production opportunity, they start to see their work in a new light. They start finding ways to get their jobs done faster without sacrificing quality. Their planning and preparation is better. They find ways around obstacles, and ultimately, everyone in the company benefits. Your customers end up happier too. Their jobs are done faster, more efficiently, and possibly even more affordably. The more productive and the more efficient your crews are, the less the job is going to cost you to do. And the less the jobs cost, the less that you have to charge your customers, or the more profit you're going to make. But if you're charging your customers less, now you have a cost advantage over your competition. And your customers, who got good work at a fair price, are much more likely to refer your company. Managing your field labor expenses is the single most important thing you can do in your landscape business. So use your labor budget, and especially your field labor ratio, to help you build and manage a company that sells more work, rewards and retains superstar employees better, builds happy, loyal customers, and generates more profit for the business. The next video in this series is how to build an equipment budget. That video is going to walk you through the process of budgeting the costs of your field equipment. We'll see you then.